What is going on, everyone? So in this video, we are going to talk about the anatomy of the stock market. We are going to break down what is the stock market, a full stock market breakdown, what is a stock, market timings, and key things to know about after hours. So this video will cover everything you need to know about the stock market so you have a strong understanding of the full market itself. Now, first and foremost, what is the stock market? The stock market connects buyers and sellers to trade financial instruments such as stocks, right? So the stock market is basically a middleman for a buyer and a seller. It connects the buyer and the seller to actually make a transaction happen, right? So let's break that down. Now, let's say on one side right here, we have Bob. Let's say Bob wants to buy 100 shares of stock Apple at $200. Okay, so Bob wants to buy 100 shares of stock Apple at 200. Now, if Bob wants to do that, Bob has to go through his broker. So Bob has to go to his broker and say, hey, I want to buy 100 shares of stock Apple at $200. Now, when I say he has to go to his broker, I don't mean he has to physically go to his broker. What I mean is he can go online on his phone and he can process an order through, let's say, TD Ameritrade, E-Trade, or any of the brokerage platforms, and he can process the trade. So once again, Bob does not have to physically go to his broker or pick up his phone. He can actually go online and submit the order, and that's the same thing as going and processing an order. Now, when Bob processes the order, right, the order is taken from the broker to the stock market. That's one part of it, right? The second part of it is on the other end, we also need a seller. So let's say we have John. John wants to sell 100 shares of stock Apple at $200. If John wants to sell 100 shares of stock Apple at $200, John also has to go to his broker. So John goes to his broker, same concept. He doesn't have to pick up his phone. You can, go online and you can submit the order. And it's the same concept as, calling your broker, but you don't have to physically go to your broker or do any of those things. Everything is done electronically. Now, when the order goes to the broker also goes into the stock market, right? And the whole idea here is now the stock market basically exchanges the two parties. So Bob gets John's 200 shares, right? So his 200 shares, John's 200 shares, are going to Bob. Bob's money goes to John, right, for the transaction. What do the brokers get? Brokers charge a commission, right? Depending on whatever broker you use. Some brokers don't charge a commission. Some brokers do charge a commission. And depending on whatever the commission is, you have to pay for it. So let's say the commission is $7. You would have to pay $7, and John's broker, let's say, charges $5. John would have to pay $5. So depending on what broker you select, which we will cover in the upcoming lessons, there will either be a commission or either there won't be a commission, right? That all depends on the broker you select. Just to go over this once again, Bob wants to buy 100 shares. He has to go to his broker. John wants to sell 100 shares. He has to go to his broker. Once they go to the broker goes into the market and they make the exchange happen. Now, a few things to keep in mind. Now, when you're buying or selling stocks, you're not always buying or selling from a real person, right? Back in the days, you would be actually buying from real people. Now, there's a lot of new technology where you're trading against computers. You're maybe trading against something called market makers, and I will break that down in the upcoming videos. I will break down the different market participants that you should be aware of. But this is just a simple explanation so you have an understanding. But it's not always going to be Bob and John. It might be one computer and another computer just exchanging shares back and forth over and over again. Now, another thing. Let's say stock Apple is trading at $250, right? This is the second question I'm sure a lot of people have. Let's say it's trading at $250. So right now, if you want to buy stock Apple, you have to pay $250. Now, if Bob wants to buy Apple for $200, and let's say John wants to sell it for $250, The question is, will this transaction happen? Once again, let's say Bob wants to buy 100 shares of stock Apple at 200. John wants to sell it for 250, and there's other people obviously that want to sell it for 250, right? Will Bob get the shares for 200? The answer is no. Why no? Because if Bob wants the shares right now, he has to pay what people are looking to sell it for, right? And I'll break that down in a bit. You have to understand, guys, when you're buying shares, you're buying it from someone. When you're selling it to someone. That could be a computer, that could be a market maker. But there has to be a buyer for each seller, a buyer and a seller, and for a seller, there has to be a buyer. When you're selling in the market or when you're buying in the market, you are not just randomly selling it to no one, right? There has to be someone on the receiving end to either buy or sell your shares. Now, we'll break that down more with the market participants, but as of now, let's break down what is a stock. So a stock is a piece of ownership in a company. Stock, shares, and equity all mean the same thing. So if you guys hear stock, shares, or equity, they all technically mean the same exact thing, right? So this is what a stock is. So let's say this is company ABC, right? So we have company ABC right here. Let's say company ABC has, 20 shares. Company ABC has 20 shares. Each one of these is a share. 1, 2, 3, 4. And then if you keep going down, we have 5. So we have 20 shares. So company ABC has 20 shares. Now, if company ABC has 20 shares, let's say each share is $5, right? If each share is $5 and company ABC has 20 shares, how much is the full company worth? Now, what you do in that situation is you multiply the shares, right? How many shares they have or how many pieces by the share price, right? Which gives us $100. So what that means is if you want to buy company ABC 100%, you would have to pay $100. A stock is basically a piece of that company. It is a piece of that overall company. This company, ABC, has 20 shares. Another company might have 400 shares. Another company might have 50 million shares, right? Every company is going to have a different amount of shares. But focusing on this example, right? If they have 20 shares and each share is $5, the overall valuation of the company is $100. Us as traders, what we do is we buy a piece of the company. Let's say I buy 2 shares. Let's say right now I buy 2 shares for $5. So I'm like, you know what? I want to buy 2 shares. I want to buy share A and I want to buy share B, right? If I buy share A and B, if I'm buying 2 shares. If I buy 2 shares right now, I'm paying $10 for the 2 shares. Now let's say I'm buying it because I think the share value is going to go higher because of reason X, Y, and Z, which we will cover. So you go and you purchase 2 shares of company ABC. Each share you're paying $5, so you're paying a total of 5. You're paying a total of 10, I'm sorry. Now what that means is if the company stock price goes up, let's say tomorrow the company's share price goes to $6 per share. Each share goes to $6. That means automatically that your share price or your total value is $12. You made a profit of $2, and since you made a profit of $2, the company's valuation, which is $100, also goes up to $120. How does it go up to $120? Let's recap. Originally, the company has 20 shares. It still has 20 shares. Before, the valuation of the shares were $5. So 20 multiplied by 5 gives us a valuation of 100. Now, the valuation of the company is, for each share, is $6. 6 multiplied by 20 shares is giving us 120. Now, we don't have to do this extensive math ourselves. I'm just giving you guys a breakdown of what happens behind the scenes, where the valuation kicks in, how shares are going up or down, what it does to you. right? But you don't have to go and do all this math. I'm just breaking this down so you have a better understanding of what happens on the back end, right? Now let's break down a few more examples of stocks. All right, let's break down stocks a little bit more, right? So we have a better understanding. Let's take two examples. Let's take stock Apple, right? And let's take stock Amazon, AMZN. And the reason I'm not putting their full name is because these right here are known as ticker symbols, which I'll break down. They're abbreviations for the stock. So these are like the codes. So if you want to look up stock Apple in the market, you're gonna put in AAPL. If you want to look at Amazon, you're gonna put in AMZN. You're not gonna put in the full name. These are the ticker symbols, right? Now let's say Apple share price is $230, and let's say Amazon share price is $1,700. Okay, this right here means Apple, if you want to buy one share of Apple, you have to pay $230. If you want to buy one share of Amazon, you have to pay $1,700. Now, if I asked you a simple question, right, saying what company or what stock do you think is bigger? What's a bigger company? What's a bigger stock? What would you say? The answer most people have is Amazon. They're like, stock AMZN is bigger because the stock price, common sense. Stock price is $1,700, but the stock price for Apple or this stock is only $230. So obviously Amazon is bigger. That's what most people think. But that's wrong. Okay? That's wrong. Amazon is not bigger, or we don't know yet. There's something we need to look into. Now, what we need to look into, going back to my last example, is how many shares does each company have, right? So Apple, let's say Apple has 100 shares, right? And let's say Amazon only has 1 share. Obviously, that's not the case. Apple, in this situation, would be worth how much? Apple would be worth $23,000. Amazon would only be worth $1,700. This right here is known as the market cap, right? You guys probably heard this term before. It's the market cap. This is the valuation of the company. This is how much the company is valued at. For Apple, it's $23,000. For Amazon, it's $1,700. Obviously, that's not the case, guys. I'm just using basic example just to give you guys an idea. So what we have to look at is A, we have the stock price. B, we have to look at how many shares the company has, right? And C, we can see what the valuation is of the company. We don't have to do the math for this ourselves. Every program that you guys use, or even if you go online, you will get the valuation of a company on its own. You don't have to do the math. I'm just showing you how the back end is done. Once again, Apple in this situation is a bigger company. Now, if you go to like the actual logistics, right, of what's going on, this is the actual logistic of these two companies. Apple is worth over $1 trillion. With this share price, Apple is valued over $1 trillion. This is actual numbers. Amazon is under 800 billion. I don't know the exact number, but it's under 800 billion. These are real, actual, factual information. Now, what's this mean? This means, as I just mentioned, Apple has way more shares, right, than Amazon does. That doesn't mean Apple's a better company. That doesn't mean Amazon's a better company or a worse company. All it means is Apple is valued at a higher price point. This right here does not show valuation. This shows valuation, right? What is the overall market cap? Apple is worth $1 trillion. Amazon's worth 800 billion, right? And now that's very important to understand. Understanding the market cap is important because you need to know what type of stocks you're trading, right? And that's a very important idea. So I'll give you an example so you have an understanding of that. Let's say we take Apple again. right? Let's say it's stock Apple, right? Stock Apple is at $230, right? And stock Apple is worth $1 trillion. $1 trillion meaning that's the overall valuation of the company. That's the actual value. If you wanted to buy company Apple right now, you'd have to pay $1 trillion, right? Now, obviously, if the stock price went down, the valuation would also go down, right? Now, let's say we have another example, and this is a mistake I personally used to make a lot when I first started trading, right? And I want people to avoid this or have a solid understanding. Let's say we take stock ABC, okay? Let's say on stock ABC, same thing. Stock ABC is worth, the share price is $230, but stock ABC has a valuation of $1 billion, right? A billion and a trillion, there's a huge difference. Now, let's say, and this is once again a major issue I used to have when I first started trading. Let's say one day company ABC goes up 100%, right? Let's say it goes up 100%. It goes from $230 to $460, right? Now, the problem that a lot of people have or don't understand is they look at every stock and they only focus on this top part. They don't focus on the bottom part. They don't focus on this part at all. We care about the bottom part. The reason we care about the bottom part is, think about this, guys. I want you to think about it for a second. If stock ABC goes up 100%, yes, the stock price went from $230 to $460, right? Now, if Apple goes up 100% too, let's say it also goes up 100%, Apple is going from $230 to $460, right? Everything here looks the same. But what's not the same is the market cap. For stock ABC to go up 100%, it needs $1 more billion. That's the only addition. It needs to add $1 billion more into the market. Apple needs to add $1 trillion more. Apple needs to add in $1 trillion more into the market for Apple to go up. There is a huge difference between these two. That's why the market cap, knowing what you're trading, is extremely important. Because if you're trading a stock like Apple, right, it might not fluctuate up or down very aggressively. It'll be a little bit safe, but it won't give you the highest risk, the highest reward, right? It won't make you the most amount of money. It won't go up 20% in a day. Stock ABC might go up 20% in a day, but it can also go down just as fast. So that's why knowing what you're trading as well is very important, right? But that goes down to on understanding a stock, understanding what a stock is, and how the pieces are put together. It all comes down to how many shares the company has, and all of this information we can access. We can access how many shares the company has. We can access what the market valuation is. We have access to all of this information, right? Now let's go over the market timing. What are the